Welcome back, everybody. I'm Jeremy Chambers, certified financial planner and founder of The Hourly Advisor. Today, we're diving into the 3 costly tax mistakes that many retirees make and how you can avoid them. Whether you're already retired or planning your retirement, this video is going to teach you ways to reduce your taxes. Mistake number 1 is converting too much or not enough to your Roth IRA. Most of you watching this video are already familiar with Roth conversions, but first let's make sure we're on the same page. A Roth conversion is when you move money from a traditional IRA or a 401k into a Roth IRA. You may do this to have tax-free distributions in the future to minimize or eliminate your required minimum distributions, or maybe you want your heirs to inherit Roth assets so they're not taxed on inherited IRA distributions. Regardless of your reason, Roth conversions can be a great strategy, but only if you convert the right amount at the right time. If you convert too much, you could push yourself into a higher tax bracket. The 2024 federal tax bracket jumps from 12% to 22% for single filers when their income exceeds $47,150, and joint filers when their income exceeds $94,300. Converting too much at once could easily push you into that higher bracket. In addition to tax brackets, converting large amounts can also push you into a higher Medicare bracket. Your Medicare Part B and Part D premiums are based on your modified adjusted gross income from 2 years prior. So if your modified adjusted gross income exceeds certain thresholds, you'll pay higher premiums. For example, if your modified adjusted gross income is above $103,000 for single filers or $206,000 for joint filers, you're paying an additional surcharge on your Medicare premium. This is called the income-related monthly adjustment amount, and it can add hundreds of dollars per year to your Medicare costs. And one thing that a lot of people don't know, unlike federal tax brackets, which are progressive and only apply portions of your income, Medicare ERMA brackets are not graduated, they're cliffs. This means that if your modified adjusted gross income exceeds a threshold by even $1, you're now 100% in that Medicare bracket, which increases your Medicare premiums by hundreds or thousands of dollars a year. For example, let's say you're married filing jointly and your taxable income for the year is $104,300, pushing you into the 22% bracket. All of your income isn't taxed at that 22%. Some is at 10%, some is at 12%, and only the amount over $94,300 is taxed at 22%. So only $10,000 is taxed at 22%. When it comes to Medicare, it's not a progressive system. If you're married filing jointly and your modified adjusted gross income is $1 over $206,000, you're now paying an additional $82.80 per person per month in Medicare surcharges, which is almost $2,000 per year for a couple. On the other hand, if you don't convert enough, you might miss the opportunity to move money from a tax-deferred account to a tax-free one at a lower tax rate. Let's take a look at an example. In this example, we have Randy and Renee Roth conversion, both age 60, planning to retire at 67. Randy has $500,000 in his 401k, and Renee also has $500,000 in her 401k. They also have $500,000 in a joint taxable account and $100,000 in a joint bank account. Like I mentioned, they're planning to retire at age 67. They want to spend $10,000 per month in retirement, and right now they're planning to take their Social Security at age 70. They both make $150,000 in annual income. Since 401k assets are usually pre-tax, their distributions will come out as income, and they'll pay ordinary income rates on their distributions. Unsure of future tax rates, they're considering Roth conversions. So the blue area represents their income. It's showing less than their salaries because they're maxing out their 401ks. So here's the interesting thing and the opportunity. You'll see that in the year they retire, age 67, their income falls off a cliff. Since they won't have any income in these years before Social Security at age 70, they can use these years to do Roth conversions. For example, if we convert just up to the 10% bracket, they could end up with around $300K more in tax-adjusted wealth. If we go up to the 12 to 15% bracket, they could have over $1 million more at the end of their plan. And if we convert up to the 24 to 28% bracket, they could end up with $4.9 million more at the end of their plan. And like I mentioned, be aware of the Medicare brackets and plan around that, but often it makes sense to pay higher Medicare premiums in the short term to have those additional dollars in tax-free Roth accounts in the long term. The advice here is have a plan that evaluates if Roth conversions make sense for you and when. See if you can take advantage of lower tax brackets without overdoing it. If you're converting to Roth, you probably feel your tax brackets will be higher in the future. So if you're converting into the 35% bracket, but your tax bracket will be 22% in retirement, a Roth conversion might not make sense for you, unless you're doing it for other reasons. Mistake number 2 is not taking advantage of the 0% capital gains bracket when your income is low. A lot of people don't realize that the tax code allows for a 0% tax on long-term capital gains if your income falls within certain thresholds. For 2024, the 0% capital gains tax rate applies to single filers with taxable income up to $47,025 and married couples filing jointly with income up to $94,050. Unfortunately, the 2021 IRS report found that less than 5% of eligible taxpayers use this bracket, missing out on substantial tax savings. To take advantage of this 0% bracket, you can sell appreciated assets during those low-income years and then repurchase similar securities to remain invested. This allows you to lock in gains at the 0% tax rate and reset your cost basis to the current market value. This means future gains will be measured from this new, higher basis, which could potentially reduce your taxable gains in the future. Mistake number 3 is paying higher taxes on your Social Security income. When it comes to Social Security, you can be taxed on 0%, 50%, or 85% of your benefits. To stay in a lower bracket, you have to understand a concept called combined income. It's a measure that the IRS uses to determine how much of your Social Security benefits are taxable. Here's a straightforward way to understand combined income. Take your adjusted gross income, or AGI, then add your non-taxable interest. Then add up how much you receive from Social Security over the year and take half of that amount. This total gives you your combined income and determines how much of your Social Security benefits might be taxed. For 2024, if you're single and your combined income is between $25,000 and $34,000, up to 50% of your benefits may be taxable. If it's more than $34,000, up to 85% of your benefits could be taxed. For married couples filing jointly, those thresholds are $32,000 and $44,000 respectively. So the planning opportunity here is to minimize your income to reduce the taxes you pay on Social Security. And when I say minimize your income, I'm not suggesting you spend less or take less from your portfolio. I mean spend from accounts that aren't taxed as income. Traditional IRA and 401k withdrawals are taxed as ordinary income, which would increase the taxable portion of your Social Security benefits. So consider taking your withdrawals from bank accounts, brokerage account positions with little or no gain, or maybe even Roth accounts. Being aware of the correct withdrawal order can significantly reduce your tax liability. So today we've covered 3 major tax mistakes that can cost retirees dearly. By understanding these pitfalls and planning accordingly, you can keep more of your retirement savings. If you found these tips helpful, make sure to like, subscribe, and hit the notification bell so you don't miss any future videos. And if you need personalized advice, feel free to book a consultation with me at thehourlyadvisor.com. Let's make your retirement as financially secure as possible. Now I want to hear from you. What are your biggest retirement tax concerns? Have you experienced any of these tax mistakes? Leave a comment below and share your story. Also, if you have any questions, drop them in the comments and I might feature them in a future video. Thanks for watching and see you next time.